you got to own everything because you never know what's going to do well and what's going to do poorly. If you're only in the S&P 500, congratulations, you had an awesome 2024. Maybe now is the perfect time to take some of those awesome gains you got last year and maybe redirect them newly into the rest of the US stock market or into the international stock market, or hell, maybe even to some bonds if you're going to get crazy.
Hi, Meg.
Good afternoon again, Scott.
Yeah. Welcome to another episode of Real Personal Finance. We were just geeking out about life and chatting and talking about clients and all that fun stuff. Hey, if we look around at like how did the stock market do last year, we're going to think about the S&P 500 and it did really well. It was up by 25%. And if we go look at our portfolios that are invested in other things, so international markets, emerging markets, maybe even bonds.
Oh my God, some bonds.
Definitely didn't return that 25% total. So the question is like, why don't I just invest in the S&P 500?
Yeah. And the conversation I had with actually a prospective client that prompted me to think about this was slightly different. She wasn't even talking about sort of the performance of her portfolio. She simply thought that the S&P 500 was how you were supposed to invest. She didn't have any concept that having your money only in the S&P 500 is in fact a problem.
Right.
Now,
right? Could be.
Yeah, it's not as big of a problem as having your money only in like the Dow Jones, which I think still is mentioned frequently in financial news as sort of the index to track.
Yep.
And certainly 30 years ago, before the proliferation of low-cost ETFs, that have made it so simple to invest in the S&P 500, people were invested in 20 individual stocks or one actively managed mutual fund. So being invested only in the S&P 500 is better than those alternatives.
Yep.
For most people, most of the time. But I think we've all sort of imprinted on S&P 500 is the thing to do. It's diversified. Yay. We can get access to it easily and cheaply. Boom, done. And the woman I was talking to basically couldn't figure out, it was part of a larger conversation of, I can't figure out why I would pay an advisor to manage my money for me. I've got all my money in the S&P 500. It's all good. Right. And one of the things that an advisor could point out to you is probably, if we dig into the details of your circumstances, having all of your money in only a portion of the US stock market, not the whole US stock market, and certainly not anything global stock market,
right,
isn't good, or it could be better. And just to sort of wrap up my thought, when clients come to us, or prospective clients come to us, it's often to solve a problem that they know they have. Oh, my company's having a tender offer. What do I do? Company's going IPO, or I just started this job and now I have $500,000 of RSUs. How do I handle this? And so they seek out a financial advisor because they know they have a problem. The difference I see between that and this S&P 500 issue is people don't know that having their money just in the S&P 500 is a problem. So they don't know to seek out advice about it.
Yeah.
Hence us talking about it today.
Yeah. And to your point, well, first of all, the larger question of why would I just work with an advisor when I can just invest in the S&P 500? That also gets away from the concept of like a complex adaptive system, which is financial planning. So your investments aren't the only thing that an advisor should be looking at for you. They should be looking at your insurances and your estate plan and your balance sheet and your cash flow and how much are you saving and to which accounts are you saving and what are you doing from a tax perspective? So of course, there's all these other things too. But to your point, just investing in the S&P 500, it does sound really good, quite honestly, right? Like if we just think like the S&P 500, I actually have this little book in front of me
Excellent.
That's
I was wondering why you were
I
wandering out
love
your
it. It's
office.
called the Matrix book. It's like all these really geeky numbers,
Oof. Okay.
but it basically, I can look at the return of the S&P 500 over any year or years. And if we go back to as far as we can, back to 1926, but I'm going to go to 1928 because that's where a lot of the other years are. 1928, the S&P 500 has returned 10% over like since inception. That's the average return, which is almost 100 years of data now, right? That's a really nice return. And the question is like, why would I invest in anything else? Well, to invest in other things, you have to remember that when we invest in things, we don't invest in things thinking that they're going to do exactly the same thing all the time. And what do I mean by that? I mean, there will be periods of time when investing in the United States will do better than investing in developed markets. So developed markets would be like China or Japan or France or the United Kingdom, places like that. Well, there was actually a period of time from 2000 to 2000 and the 2000 to 2009 timeframe that the S&P 500 actually didn't return anything.
Yeah.
But the rest of the market, the rest of the globe did. So in that decade, being invested around the globe was really helpful to you. When it's a period of time when the S&P 500 is winning and everything else isn't, it doesn't feel like it's helping you.
Right. And I think, I mean, what you're basically just talking about is diversification, right? You want a diversified portfolio. And I think one of my favorite quips about diversification is diversification means always having to say you're sorry.
Always.
Because there is always a component of your portfolio that's doing poorly because you own everything.
Yes.
And I think what strikes me is, I'm sure you also work with people who come in and they have basically all of their money in tech stocks.
Yes.
And that is a sort of clear example of concentration, or a clear example of not being diversified. And people recognize that. Even if they don't want to change, they recognize that they're not diversified. But people think they're diversified sufficiently with the S&P 500.
Yep.
But some numbers and some cool looking charts that you were showing me earlier during our hour of chit-chatting before recording this 20-minute podcast.
Which is always the fun part.
Yeah. You were showing me this really fun map visually indicating the size of the global market that each country makes up.
I'll bring it up right now.
Okay. And what that map was showing, and it's a year or so out of date, so numbers have changed, but sort of not categorically, is that the U.S. market makes up, I think, 61, maybe now 65% of all the companies, publicly traded companies in the world. Okay, so if you're in the S&P 500, you're only buying U.S. stocks. So all of a sudden, you don't have 40% of the global stock market in your portfolio. And the S&P 500 is only 80% of the U.S. stock market.
Yeah.
So all told, if all you own is S&P 500, you are missing out on half of the stocks of publicly traded companies in this entire world. Right. Half of them, if you're only in the S&P 500.
Right. So like that's the the S&P 500 are the 500 largest stocks largely in the world, pretty much. Right. So like if we think about the top companies now, they were the Mag 7, but they had to change the name because I don't know if you guys know this, but Broadcom actually did really, really well last year. Shout out to Broadcom folks. Like it was up over 110% last year.
Wow.
So it definitely beat out Tesla and Meta and Google and all the companies that we're supposed to beat. But then also like, let's say that, looking at this, if you guys do go look at the YouTube channel, you'll see this map that Meg was talking about. And so what it does is it looks at global diversification, but it puts it out like it's a globe. So it starts with the United States is 61% of the world, or $50 trillion of market capitalization. That's a lot of money. To Meg's point, 40 trillion of that's the S&P 500, but 10 trillion of it's really small companies that you don't know the names of. And if I go look at history, small value companies from back to 1928 to now have returned about 13% per year, but the S&P 500 returned 10. So I want to own those small companies too. Now, last year, the small companies didn't do as well as the large companies. Does that mean that I stop investing in them? Absolutely not. I want to put probabilities in my favor for me to outpace markets over time. And that's really all that we're doing is we're looking at, hey, if we get to play the probabilities, how do we play the probabilities in a manner that help us get the best expected return we can over market cycles? We don't care what happens in any one year, any one month, any one time period. We care about the entirety of our investing career. Does that make sense?
Well, it makes sense to me, but perhaps that's no surprise.
Right. But that's the idea. But if we look at it this way, okay, so 61% is the US, 3% is Canada. All of Canada is only 3% of the globe, right? Like China is also 3% of the world. So if you're ever worried about China, fun fact, like Nvidia and Apple and Google are all larger, relatively speaking, in the globe to China and Canada.
In the global markets, yeah.
Right. So like their position in the markets is that's how big they are, $1 trillion companies. So, you know, you might be more interested in what Tim Cook has to say than what like the president of China is saying as far as what markets are going to tell you. But point is, we want to invest all around the globe. Like, did you guys know, for instance, that I didn't know this until the other day? Well, I did know it actually, but my family didn't know it. We were driving in on vacation and we were in a Dodge Durango. And I'm like, guys, who owns Dodge? And they're like, it's a US company, of course. And I'm like, no, actually, it's Italian. So like Fiat bought Daimler Chrysler during the 2008 financial crisis, right? And so now it's an Italian company trading in an Italian market, which is part of the 1% global capitalization of the Italian market for the globe. But I want to own the best car manufacturers in the world. One of the top manufacturers in the United States is from Japan, Toyota, right? So like, I don't want to just own US auto manufacturers. I want to own global manufacturers. And then another way you can think of it is like Nvidia, one of the biggest returns, right, of the last few years. Amazing. Well, Nvidia essentially makes recipes is what they do. They make plans for how to build chips for AI. But who builds the chips? Taiwan Semiconductor builds the chips. That's a Taiwanese company. So I want to own the Taiwanese company too. They're the company that actually makes the chips, right? And then there's another company that actually makes the equipment to make the chips from a different country, right? So there's a reason to own companies all across the globe. And I'm not going to pay attention to, oh, well, the S&P did better than everything else, so I'm just going to invest in the S&P.
Yeah, I think there's a real danger in what you're describing, this idea of sort of benchmarking your wholly diversified, globally diversified portfolio against just this one, half of the global marketplace, which is the S&P 500.
Right.
Those two comparisons, it's not apples to apples. What I was thinking of is for the people who own the S&P 500 and think that they are sufficiently diversified, right? It's not like they're trying to make a concentrated bet.
Right.
They just don't know that that's in effect what they're doing, that they're only owning half of the stocks that they could own. In a very practical sense, like it's very easy to get the other half, right? There are ETFs and index funds out there that with the click of a button, with a single fund, you could own the entire international stock market outside of the US. Or, if you own an S&P 500, there are lots of these what are called extended market funds, which are the rest of the US market. So just from a very practical perspective, if you find yourself just in the S&P 500, it's just as easy to get the rest of the global and rest of the US stock market in your portfolio as it was to get the S&P 500, because there are tons of low-cost ETFs and index funds out there that you can get it through just by owning a single fund.
100%. The top 10 companies in the S&P 500 are 37% of the S&P 500. So there are 500 companies.
Yeah.
Right?
Oh, I love those graphs that show that sort of distribution. They're just sort of bonkers to look
So
at.
10 companies is only 2% of the 500 companies.
Yeah.
But those 10 companies, that 2% of the 500 total companies makes up 37% of the pie.
Yeah.
It's massive. Now, if you go own the entire world, I don't quote me on the exact number, but it'll shift down to around like 20%. Right? Those 10 companies.
Right. So you're not as sort of ridiculously concentrated in just that short list of 10 companies.
Right.
Yeah.
Because one of the things that I worry about for people, and this is, it's an argument to be made for, you know, whenever we look at markets as a whole, we can look at markets and you can look at the price of something, and it's hard to understand how that price compares to other prices of other things that you can buy, right? Like, okay, so, let's see, I actually have I track some stocks for clients just to see how they're doing, because it's something to keep an eye on. So, Microsoft's trading at $444. Amazon's trading at $234. But like, you can't compare those apples to apples, right? But what you can do is you can actually use some ratios of price to other things, like the book value of the company or the earnings of the company and other things, just to get a sense of, well, how are they actually doing, and compare it to historical levels. And so one of the things we think about with large companies is we can break companies into two categories. We can call them either growth companies. So that'd be like Tesla and Nvidia and Google and Facebook and all the companies that are just kind of shooting the moon right now, right? They're growing really fast. Those are going to be more growth companies. Value-oriented companies are going to be more like probably older automotive companies, maybe some energy
something
companies.
Like Procter and Gamble.
Procter and Gamble would definitely be in that mix. But what you can do is you can just go look, okay, over time, this is as far back as we have the data, what have the price to book ratio of large growth companies been? And if I'm just ballparking it, I'm going to say maybe it averaged around 4, right? So all that means is if I take the price and I divide it by the value of all the assets on the book value of the company, the price is going to be 4 times more than the book value. That's going to be about the average. And for value companies, it's like maybe 1.25, maybe 1.5. I'm quickly just ballparking looking at this graph. But then if I ask the question like, well, is value relative in like its range for relative price? Does it still a good buy? Looking at this, yeah, it looks decent. And then I go look at large growth and I'm like, ooh, man, it's at like 10 times the price to book right now, when the average is probably around 4. So
if only we had another line in that graph to show us what the average was, you'd see that we're well above it.
Well, but you can kind of just look at it if you just think about where that regression line would be. It's getting pretty pricey.
Most people don't think in terms of regression lines.
Right. Regression line's super nerdy.
Yeah.
Sorry.
Your CFA is just coming out.
I know. It's real personal finance, which is supposed to be like plain English. Think of like if you could draw an average line of these lines. That's really what a regression does. But what I see right away is I go, ooh, man, it's getting kind of pricey. And when things get pricey, I worry about this thing called reversion to the mean. And reversion to the mean essentially just means that when something gets too pricey, it eventually comes down in price to get back to the ratios that it's usually at.
Yeah, it just comes back down towards the average. And if it's above the average, it means it's falling.
Right. And if it's below the average, it means there might be an opportunity to see some upside. Yep. So I just look at it through that lens, and I can't predict what's going to happen in the markets this year. If anyone tells you they can predict what's going to happen in the markets this year, run away from them. I would choose not to believe them personally. Because I don't know anyone who can predict it. There was actually an amazing little blurb the other day that I saw of every major like institutions' prediction for what 2024 was going to
they're
be for
always
the S&P
hilarious
500.
after the fact.
And like, the average for the certain number of years, the S&P's been about, 10% forever, but for some period of time they were looking at was about 12.3. Obviously, we ended up at 25. None of them came even close to like a double-digit prediction, and 6 of them said it was going to be negative last year.
Yeah.
So like, don't worry about what predictions are going to be. Worry about like what allocations make sense for me, and be pragmatic for the long term, and invest globally, because it's the best free lunch you're ever going to get, even in years like now when it doesn't feel lovely.
You got to own everything, because you never know what's going to do well and what's going to do poorly. If you're only in the S&P 500, congratulations, you had an awesome 2024. Maybe now is the perfect time to take some of those awesome gains you got last year and maybe redirect them newly into the rest of the US stock market, or into the international stock market, or hell, maybe even to some bonds if you're going to get crazy.
Yeah. Do that. Yeah. If that makes sense for you.
Yeah.
A little bit of sad news, but sadly, Meg was kind enough to join me on the podcast with an open-ended invitation.
Yeah.
And it's time for her to step away. So you'll be missed.
Thank you, Scott. I very much appreciate your generosity and graciousness over me leaving. I just decided writing is just my bag.
Yeah.
Right? I don't think I come off horribly on podcasts, but like, you can never go back and redraft it. And I'm a redraft it umpteen times kind of gal.
Yep. And so where can people find you in the future?
Yeah. Well, I mean, if you want to, I am told that if you read what I write, it's as if I'm talking in your head.
Yeah.
So if you want to hear my voice, as it were, the blog on my firm's website, which is flowfp.com/blog, flow as in water flow, cash flow, FP as in financial planning.
Awesome. Well, it's been a joy having you on, and thank you.
Yeah, you're welcome.
And
Thank you.
I will see you all next time.